Hi everyone, this is Brian Neal with TradeToBeFree.com. Just want to give you a market update here after the long weekend. The S&P 500 and NASDAQ are still within this range here that we've been in for most of August, actually all of August. And now we're starting back in it within this range here from about 29.50. It looks like to 28.20 on the S&P 500. And it looks like we're bouncing off the top of the range right now and pulling back. We just saw a manufacturing PMI number this morning that was contractionary, slightly. That's like 10% of the economy, though. That's a smaller portion than the services. And the services come out on Thursday, so that might be a market-moving event. If that's really weak or if it's really positive, it could go the other direction, too. So we continue to be in this range, though, in the meantime, and we're looking for a break above the 29.50 area, really, and hold above there, get more aggressive, cautiously become more aggressive at that point, and then if we can get above the prior highs and hold there for a few days, then more aggressive at that point. But we could still see, some bad news this week. Usually after the Labor Day holiday, when fund managers come back from vacation, there's more players, big players in the market. You often see that first week or so kind of set the trend for the next several weeks. Okay, so either today or later this week, like I said, or early next week, we could see the market break either way, and that could set the trend for the next few weeks. One thing I've noticed for the past week or two, and what's been in the news too, is that the 30-year Treasury yield is actually below the S&P 500 yield. And I went back and looked at all the monthly S&P 500 dividend yields and also the 10-year yield month by month, and I noticed when what happened when the 10-year yield went below the S&P 500 dividend yield. Okay, so the 10-year yield is just the yield you get holding a 10-year U.S. Treasury. Okay, and the S&P 500 dividend yield is just the yield that those companies in the index will pay you for holding their stocks every year. Okay, so there's sometimes in market history where the S&P 500 yields more than the 10-year yield. Okay, and going back to the past 10, 12 years, I noticed that back in late 2008 and early 2009, if we expand this a little bit more, we can see that period here. Looking at those numbers, it was late 2008, 2009, where you started to see that the S&P 500 yield more than the 10-year, and the 10-year is considered a much less risky investment. So it's pretty significant when that dividend yield goes above there. Okay, and that actually corresponded with pretty close to the lows during the financial crisis, and we saw a really nice rally over next year. Okay, we also saw that same thing occur back in late 2011 and also in the mid part of 2012, I believe, and I think later in 2012. Okay, and the market went on a strong run from there, and then we saw it occur back in early 2016. Okay, and the market made a really nice move from there, and also we saw it in December and also last month again, where we saw that dividend on the S&P 500 yield more than the 10-year yield. Okay, so each time it's happened before, the market's ripped higher for another year or two after that. So a lot depends, though, if we'll go into recession or not. If we don't, or if we see a mild recession, we might see a really strong move from here onward and higher. If we go into a sharp slowdown and a recession, then of course the market will probably sell off, and we'll probably break this long-term uptrend support here on the S&P 500 and NASDAQ. Okay, for swing trading, though, I don't really care that much about that longer term. What I care about is over the next few weeks, and so all I want to know is when the bearish market signal occurs, and that was right up in here. And very often these fail to produce a large correction. They often just lead into a pullback in the market, followed by a regaining of the traction of the long-term trend. And so we might see that those market averages close above here and continue higher, and we could definitely see that until that point where we confirm a new trend back to the upside on this intermediate term time frame, okay, which is over the past few weeks to a few months. Once that intermediate term trend goes back to the upside, then I'll get more aggressive with long trading opportunities, trading those more aggressively, okay, and especially once we get above here and hold above the prior high, because that could be just, again, this could be just a long consolidation within the longer term trend, and we can see that, once we yielded more in the S&P 500, more than the 10-year here, and started moving into new highs, we had a real nice uptrend in the market. So we could just be breaking out of this long-term trend. We've got a higher low developing potentially here and could break the prior high and continue on north. Now that's the bullish case, and which one will win, the bullish case versus the bearish case, no one knows for sure. And so what I do is wait for the market averages to tell me which way the market wants to go. Okay, so if we get a higher low followed by a higher high, a swing low and a swing high, and there's a way to determine what that is. You can't just go by a daily candle to figure that out. It's a little more complicated than that, but we want to see the trend confirmed back to the upside. And once that happens, then I can get more aggressive with my long trading opportunities. And if not, if it continues to trend lower, then I'll be more risk adverse, look for the best short opportunities, and also look for the best long opportunities at the same time. We'll just have to wait and see which way the market breaks. Until then, we'll just pick the very best long opportunities and the best short opportunities. We want to be careful too of the VIX, make sure that the VIX volatility index is not too high for some of our strategies. Right now, I believe the high tight flags and the earnings eruptions trades are still working. We saw a Burlington Stores last week make a really great move out of an earnings eruptions trade that set up really nice using the rules in the course. I believe it made like a 5 to 10% move higher from the technical entry point within a day or two. Okay, so setups like that can still work. Right now, we're right on the threshold of how much volatility those strategies will withstand before the win rate goes down to a point where it just doesn't make as much sense to trade them. Okay, and we have to be even more careful with those. We got to really pick our shots here, long and short. And once volatility dies down and we have our next confirmed market uptrend, which may be, maybe up here, it may be after a large correction down to here or lower even, and then it confirms a new uptrend at that point. Who knows at this point? Okay, so I just want to follow the market averages and which way the market trend is going currently, and make sure that the market trend is in alignment on all time frames, or at least most time frames anyways. Use that to determine whether to be more aggressive or very careful, and also looking for the best short opportunities. So, all right, that's about it for now, guys. All right, thanks for listening, and the next update will probably come out later this week or early next week, and we've got some really good trading opportunities on the site this week that are setting up, so check that out.